please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, the market is quite decent right now. The mid-caps are doing well, mid-cap IT in particular. CONCOR has posted a good set of earnings with higher volumes from rails. Kalyana Rama, CMD of CONCOR, is with us now. Mr. Kalyana Rama, good morning. So, good performance. I'm looking at EXIM segment, domestic segment, all of them doing well. But challenge is this sustainable? Do you have any visibility on that?
Yeah, good morning. Yeah, there are always challenges in the business, but whatever strategies we adapted, they are giving us results. And I'm hopeful that now the Q4 also we will be able to perform very well. Okay. Because the direction what we have taken is giving us very good results.
Okay. Mr. Kalyana Rama, good morning. Can you give us exactly what were the volumes this quarter, as well as what kind of realization growth did you see?
There is a growth in realization. Actually, in both EXIM and domestic, there is around, I can say around 8 to 10% growth is there in the realization. Okay. This is basically in EXIM, it is coming out of the double stack running. But double stack running is only one section is available. We are utilizing it fully. It, in cooperation, in dialogue with the railways, Indian railways. There will be some challenges there. But we are getting higher volumes. In fact, we started moving some of the cargo, which is for the, not actually meant for CONCOR, but we are helping out other operators and we are moving their cargoes in the double stack segments. So it's, in fact, the growth will be good in the double stack side. Okay. On domestic side, the price realization is good. There is a demand after GST. Now the effects of GST are almost over. So we are seeing good growth in domestic.
Okay. Well, good morning, Mr. Kalyana Rama. If you could give us some idea, therefore, since you say that most of the GST changes are over, what may be your capacity utilization in the last quarter and through 2018 calendar? How much growth in your capacity utilization can you see?
You see, our throughput is increasing by 12%. What the forecast what we given in the beginning of this year, we are able to realize that. In the originating volumes, in both, EXIM is giving around 8%, but in domestic we are almost getting around 17% growth. In the first 9 months, I can see 17% growth has come in the originating volumes.
Okay.
And overall throughput, both combined together, we are getting 12%.
Okay.
So that is why I'm mentioning that, GST effects have come out.
Okay, no, let me ask for a more specific number. Say, this empty running losses, how much was it in Q3? How much might it fall to in Q4 and in the first quarter of next year, you think?
You see, we are almost reaching an optimum level in empty running. See, this 9 months, we had an empty running cost of around, I think, 180 crores. I exactly don't remember the number now. But we are decreasing every quarter 10 crores empty running cost. Quarter on quarter, in the first 3 quarters, there was a drop of almost 10 crores every quarter. This quarter, maybe in the same region or maybe slightly less. So after that, there will be, because that we are bringing this to an optimum level. Beyond that, there will be an empty running required in the logistics. It can't always be balanced.
Okay. What is the volume expectation, particularly from railways, over the next 2 to 3 quarters?
Volume expectation, as I told you, the throughput we will be going around that 12% growth, because this is, related to the export-import elasticity. That's what we are expecting. And once the program of that Make in India and all, if really takes up, then there is a further growth expected in this. Then we can expect more growth in these volumes.
Okay.
But if you see the numbers, the thing is the margins have improved.
Yes.
Our bottom line is increasing faster than the top line.
Okay, actually that was going to be my last question to you, Mr. Kalyana Rama. Margins have grown up to beyond 27%. What may be a reasonable expectation for the fourth quarter, since you have already seen 1 month of this quarter? And secondly, what is the problem? I mean, this higher employee expenses, Is this a one-off? Should we start to see it tapering in FY19?
Yeah, obviously. This is because of the third pay revision we have given to all the employees, and also the arrears payment we did for the 9 months, because the pay revision has come into effect from 1st of January this year.
Okay.
So that employee cost was almost in this 9 months 77 crores more than last year.
Okay.
But then this is a one-off expense. There will be slight increase in the employee cost compared to year on year, but next year it will only the general increment what we give around 3% and some DA increase which will come in the natural course.
And margins?
Regarding the bottom line you are asking me.
Margins, yeah.
Margins, yes, that's what bottom line, what we have given the margins, I gave a forecast of 12%. But now I am confident we will be able to post a better thing for the year, maybe around 20% now.
Jim O'Neill, former chairman of Goldman Sachs Asset Management Company, is now with us. Thank you very much for joining us on the show, Jim. It's an opportune time because, you know, all global markets, or most global markets, are rising synchronously. You've seen many such cycles in the past. Does it at all look like irrational exuberance to you?
Difficult to answer. I mean, obviously, by definition, the more all markets rise at the same time and they don't discriminate between different fundamentals, whether it be sectors or countries, then that does tend to suggest one needs to be careful. But that said, the world economy is probably the strongest it's been for at least 11 years. So, and we don't have much sign of inflation, and the top 10 economies all over the world, with the possible exception of the UK, are all participating at the same time. So in that sense, probably most of the equity rally is a bit of a relief that finally, 10 years after the mess of 2007-08, the world looks a better place.
Yes, in fact, everyone is talking about growth. We are getting growth, but does this growth look stable? Can we say we're in a new normal versus what we've seen in the last 11 years?
You know, if I look at the coincident and leading indicators that served me well in the past, this time a year ago, it looked to me as though 2017 was going to be better than most people realised. And I'm slightly uncomfortable that now global strength is becoming a more widespread view, because frequently, you know, the consensus is kind of behind the scene. But if I look at those same set of indicators, they are all very, very strong. You take South Korean trade data, South Korea being the fastest country in the world to report its trade every month. Their December numbers confirm that for the whole of 2017, South Korean exports rose by the strongest degree since South Korea first started reporting trade data in 1956. So, contrary to the ridiculous pessimism of a year ago, world trade has been very strong and appears to be accelerating. And you take the PMI surveys, the monthly business confidence surveys in many places. Take Europe, for example, the Eurozone, strongest for 20 years. So a lot of these indicators are very strong. And unless we have some major new shock or significant tightening of monetary policy, they are probably going to stay very strong. So certainly right now, it seems to me the consensus forecast for the world economy, even with the IMF's recent optimistic revision, are probably still not strong enough for what's actually going on in the world economy right now.
Okay, Jim, so if the growth numbers are good, is there a chance that equity markets may repeat their 2017 performance in 2018?
Well, luckily, I don't have to professionally come up with guesses or forecasts about any of these things, particularly financial markets, so I don't have to worry about it. But that said, even if the world looks as strong as I've said, it doesn't necessarily translate into equity markets performing just as well as they've done the past 12 months, because at some stage, if we carry on with this strength, we will probably get more central banks, other than just the Fed in the US, deciding that they shouldn't be so accommodative as they have been. So at some point, I think we'll have a bigger test for the equity market's resilience from monetary policy than we have had in the past 12 months. But trying to guess when that is you know, your guesses or your viewers' guesses are as good as anybody else's, to be honest, in my view.
But Jim, the rate hikes will come only if growth stays good. So will the rate hikes be such a showstopper?
Well, I don't think we have to worry about it too much in the first quarter, because as you see from the tone of what's coming out of Davos early on this week, and the tone from the IMF, and the tone from a number of central bankers, they're still all worrying about all the things that could go wrong. And of course we have some of this strange stuff coming out of Donald Trump in the US about trade again. So I don't think we have to worry about that in the first quarter. But going back to my underlying point, if you look at the indicators that I've followed for years in Europe, probably the cyclical momentum in the Eurozone is probably at close to 3% right now. And if that starts to come through the official data, then I would guess the ECB by the spring will be changing its generous tone from what it appears to be at the moment. For example, and maybe even here in the UK as well, where we still have a Bank of England that's really worried about, of course, Brexit and worrying about all sorts of things that could go wrong. They might end up having to change the mood as well, but we'll have to see.
Okay, let me pull you closer home then to India. What would you want to see in the budget? We're just a few days away from that.
I mean, you know, let me really emphasize that I am not looking very closely at the discussion about what may or may not come in the budget before it. And again, linked to why I said what I said before, and as you know, I'm not in the financial markets every day of my life anymore, so I don't have any interest in following these things on a daily basis. So I don't really have strong expectations, but what I would say is obviously last year, two of the significant reforms that Modi announced both appeared to actually slow down growth. So I would imagine that means he's going to be careful and cautious about announcing any big surprises in the budget. But I may be wrong. But if there were something that I would really hope to see more evidence of, is stronger efforts to do something about improving the education spending in India, because of course India still has this enormous education challenge, and trying to follow through with a bit more specific policies about this whole idea that seems to have disappeared a bit about India shifting more towards manufacturing. That's not just going to happen just because Modi has said he wants it to happen. It's going to require India to do something. So maybe taking a leaf out of China's book and trying to do a bit more on opening up India to foreign investment in key sectors, and rather than thinking of foreign companies as a threat, think of them as something that might help boost Indian productivity and boost growth. These are the sort of things that I would like to see and would encourage Modi to do, but whether they're going to happen or not remains, of course, to be seen.
Okay, Jim, finally, let me end with the commodities cycle, and I'm not asking you to predict a level, but in general, crude metals had great 2017. Could 2018 be even better?
Actually, I think the last time I was on any part of the CNBC network was from a big oil and energy conference in the Middle East in November, and I just before I went on air, I'd heard some top executives saying that the oil price would be about the same level 12 months' time from where it was that day. And I joked to some of your colleagues that the last thing that will happen is oil prices be the same in 12 months' time to where they are on any one day. And if I were forced to choose, I thought they'd be closer to $80 than 60. And here we are 2 months later, and we're halfway there. So I would imagine this rise in the oil price has got further legs to go. It's primarily being driven by this very strong recovery in the world, and I've no reason to think that it won't carry on for some time. Obviously, at some price, it will result in more supply coming onto the market, and that will cause the price to reverse again. But the one thing I could virtually guarantee for you is that the oil price will never be stable. But there you go.
Okay, well, we leave it at that, Jim. Thanks so much for joining us and giving us your view. So that's the world view, but drilling it down to individual stocks, Biocon is definitely one of the key stocks on the downside, post their numbers, but the management had a conference call a while back. Ekta joins in now. Ekta, the margins have taken a big hit this time. What did the management say to justify that?
Well, yes, the margins have been lower this time round, but I just want to reiterate that maybe the reason why you're seeing the profit booking is also because of the kind of run-up that we've seen in the stock as well. So the management did say that this quarter, it wasn't satisfactory in terms of the kind of performance that they saw. The margins were mainly lower due to lower licensing income as well as the fixed costs due to Malaysia. They don't have any sort of particular guidance on margins, but they expect the biosimilar business as it grows will eventually aid the margins. The biologics segment, which is basically again biosimilars, should bounce back in FY19. The small molecule segment, which is around 35% of sale, continues to see that channel consolidation and price pressure in the US markets. Syngene performance is gaining traction according to them. Interestingly, they spoke a lot about the biosimilar business and the unlocking there. We had questioned them about this, and they said that yes, listing of the biologics business would be something, or the biosimilar business would be something that they would be looking at eventually. Now, the reason for that is that Biocon does expect their R&D costs to go up simply because of things such as their latest tie-up on biosimilars, which they had with Sandoz, and with that there would be a cost share which would eventually probably impact margins, and there would be that capex requirement which would be funded with the biologics business listing. So that was one of the key important takeaways according to me.
Okay, thanks a lot for that, Ekta. Well, as we end Bazaar, a couple of stocks are looking interesting. NIIT Tech has moved to high point of the day, and one stock which has moved to low point of the day right now is Jubilant FoodWorks. Just pull out the intraday chart of that stock. It could be the expiry pressure because it has had a big rally, and right now that stock is trading at the
on the opposite end is Westlife, but that's not F&O. It's just that it's not a well-traded stock. Yeah, metals actually have been a strong point today, as have been realty stocks. Actually, the market is not in a bad spot at all, considering that one thought there were global headwinds in terms of the weak dollar and a bit of unsettling. The market's done well to just hold on to previous gains. Let's see how things go. It's going to be definitely a choppy day, it being expiry day. A lot of trading ideas coming up for you on Chartbusters in a minute. Thanks for watching us.